No matter what year we were born in, when we look back, we all feel India has come a long way. Think about this, from 2.7 lakh crore of GDP in 1947 to 121 lakh crore today, from electricity in just 1500 villages then to 6 lakh villages now, and from a literate population of only 12% in independence to 74% in 2018. All of us, of course, know that India has an equally long way to go. In 1947, when Pandit Nehru delivered his famous address, he talked about how India was making a tryst with destiny, awaking to a new future. As we look towards 2025, India is on its journey to becoming a $5 trillion economy and will now make an economic tryst with destiny. Momentum, scale, sophistication. And one of the most important parts of this economic tryst will be a multi-fold increase in financial assets from domestic investors, a journey towards financial freedom. From a country of just 11% MF to GDP penetration to a journey of 40 to 50% penetration, which is in line with the rest of the world, we really have miles to go and also grow. An important part of this journey of financial freedom is financial literacy and becoming better and better investors ourselves. I find it fascinating to scroll through history because it is a great teacher. So today I thought I would share 3 of my favorite quotes from history and perhaps what they can teach us about investing. The first quote I want to share. If no one ever took risks, Michelangelo would have painted the Sistine floor, not the Sistine Chapel. The Sistine Chapel, as many of you know, in the Vatican, is one of the world's finest and most famous architectural marvels. A story goes that originally when painter Michelangelo was asked to paint the ceiling of the chapel by the Pope, he refused because it was too risky and too difficult to paint a ceiling. He eventually agreed and he painstakingly drew and painted in different colors on the ceilings for years, to the point where he had back problems. He left a legacy and he left something unmatched. Anything that stands out, anything that is not average, involves taking some risks, and that's also true of money. We have this illusion that fixed deposits, and we are a country with a very large 130 lakh crore FD base, involve no risks. But the real returns, the net of inflation returns in FDs in many years are negative. In fact, the real returns of FDs from 2001 to 2018 are just 14% absolute. In contrast, the real returns of equity in the same period are over 170%. Orient your mind to be comfortable with risk, because risk is the starting point of return. The second quote I want to share. If you're going through hell, just keep going. Said during World War II, hell is something that all of us have experienced. Sometimes a personal crisis, the loss of a close family member, sometimes through a professional crisis like a layoff, or a really tough run at work, sometimes through a bout of very bad health. And hell feels horrible when it happens, but most of us persist and get through because hell doesn't last forever. Markets are also subject to hell. They have and they will, in the form of market corrections. And in that period, there is noise, media, bleeding red portfolio values, the thought about whether we were better off not investing and what we could have done instead. We just have to get through without stopping our SIPs, without deterring from our asset allocations, because every correction does come to an end. And the final quote. History will be kind to me because I intend to write it. India's economic history from 1991 has seen it all. We've seen the 13-day government of Atal Bihari Vajpayee. We've seen the Harshad Mehta scam. We've seen the Kargil war. We've also seen the greatest bull run from 2003, but also the terror attacks in India and the global financial crisis. At the end, markets have delivered a compounded return since 2001 of over 14% on the Sensex. In 1 year, markets are extremely volatile, in 1 day, and even in 3 years. But over 10 years, volatility comfortably subsides. What's important is having control of yourself and your behavior and writing your own investment course in history. Use corrections as an opportunity because timing can help. Your compounded return till today, if you invested at the peak of 2007, would have been just about 7%. But if you had invested in the 2009 lows, it would have been about 13%. Use the power of tools like SIP or dynamic asset allocation funds to take advantage of these times in market history. For instance, so you can benefit from events rather than be rattled by them. I'll end by sharing that as domestic investors in mutual funds, we've come a long way and we should never underestimate it. Many years ago, India was an FII dominated market, and today FIIs share the stage with an equally powerful word, SIP. From 2012, where equity AUM was 83% FII and 17% domestic, we as domestic investors are already 25% of equity assets today, and we will hopefully continue to get larger and larger in this journey towards financial freedom. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.